CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Why don't I go ahead and just kind of kick things off? I'll quickly introduce everybody. So yeah, my name is Gabe Selby. I'm the head of research here at CF Benchmarks. I'm just going to be moderating for a bit, and hopefully Ken's his phone starts working here and he can join the space. But before we dig in, I want to remind everyone listening that this discussion is for informational and educational purposes only and should not be considered investment advice. The views expressed are those of the individual speakers and do not necessarily reflect the views of CF Benchmarks, Kraken, or Payward. Always do your own research and consult a licensed financial professional before making investment decisions. All right, good. Glad to get that out of the way. So let me go around introducing everybody pretty quickly. We've got Tomas Perfumo, who's the chief economist at Kraken, joining us. We've got Thomas Erdosi, our head of product at CF Benchmarks. As usual, we got Mark Polepchik. He's our research analyst here at the team here. And soon we'll hopefully have our head of content, Ken, join us as well. Just to offer a quick roadmap for the next hour or so, we're going to be doing first talking about some top stories. So we're talking about Warsh's hearing this week, what's going on with that. Also, we're going to be diving into strategies, recent Bitcoin buys. They've been accumulating more and more, it seems like. So there's a lot to kind of go over with that. And we'll talk a little bit about probably the preferreds as well. CME has also announced that they're going to be going live for 24/7 trading on May 29th. So that's a pretty big deal. And we're going to also briefly touch on the Kraken Binomial deal that was announced last week, which was made a big splash in the industry, what that means for the space overall. To close things out, we'll always talk about what we're looking for in key events in the week ahead. We also are going to cover some deep dives in relation to AI and DeFi security. We, of course, had a nice DeFi hack over the weekend where basically the Kelp DAO saw some assets being hacked on a bridge, and we'll go into more details about that. And then we'll also talk about the latest CF factor performance breakdown. So just to kind of kick things off, let's begin kind of with the Warsh hearing, because this is something I know, Tomas, you've been researching a lot as far as Fed dynamics, what the succession means, how is this going to impact monetary policy going forward. Essentially, Kevin Warsh testified before the Senate Banking Committee just 2 days ago on April 21st. He was pretty consistent in holding the independence line. I think I don't know if it was Elizabeth Warren or somebody implied that, or asked if he was going to be Trump's sock puppet, which kind of was a term that was continuously thrown around throughout the rest of the hearing. And then the other character, I think, in the hearing was Senator Tom Tillis, who, of course, is continuing to block confirmation until the DOJ drops its investigation into Powell's congressional testimony. So that's basically covering the testimony over the Fed's HQ renovation. So that's basically been the case for some time and causing a lot of uncertainty on what the succession is going to look like. Tomas, I just want to ask you, from the top, has anything really changed after this confirmation hearing, or are you still kind of seeing the same roadmap that you outlined before in your blog post?
Yeah, I mean, the blog post kind of just highlighted 3 high-level scenarios. Like, are we going to have a grind, kind of like what we're seeing right now with status quo, where everything's very reactive? Are we going to see a Fed shift more dovish and like forward-looking and active in that sense? Or are we going to see kind of like what I call like the run it hot scenario, where we're just going to go ham on the balance sheet and interest rates and just pretend inflation doesn't exist? And I think from the confirmation hearing, it was probably in the middle of the road in terms of what consensus had already expected. So when it comes to the 3 scenarios, it leaned into what I call the soft pivot, or that kind of middle dovish scenario that we were referring to, which is, we know that Warsh has indicated in the past that he wants to complete some regime change at the Fed in terms of communications, how to think about inflation, et cetera. And he really expanded and confirmed all of those viewpoints as part of his hearing testimony. And so I think that kind of reaffirmed that kind of middle of the road scenario there. The negative, or let's call it like the ongoing uncertainty that exists, is what you mentioned, which is all of this investigation and how that's impacting the transition in leadership with respect to the confirmation vote, with respect to Jay Powell saying that he's going to stay until the investigation is closed. And I think those things make it difficult to realize a quick, clean transition that's as decisive as what Warsh was communicating during the hearing. So that's kind of the high level take I have on it.
Yeah. I think that's pretty good. I'm also just kind of interested as well in kind of like this transparency angle that seemed to be reported throughout the media after the hearing, where it was brought up a ton about deprecating the dot plots or changing the way we view forward guidance, or even kill forward guidance altogether. To me, the transparency angle is something that, of course, is something that's I think a bit more subjective per each, I'd say FOMC regime with each chair, as far as the way that they want to handle their meetings and talk about what their frameworks are going to be. And in that sense, I think Kevin Warsh has a right to kind of, have his impact on the institution. But as far as deprecating the dot plots or the changing, the way we get the summary of economic projections, are these things that you are kind of taking note on as far as being impactful for markets?
Yeah, I mean, all things considered, I would say that the increased volatility in a market that has a lot of expectation for, let's call it like stability and like, maybe cautiously proactive when it comes to easing on monetary policy in general. And I guess the straightforward way I think about it is it's kind of like a trade-off in independence, where people have this assumption that by withdrawing communication or guidance, that it's a submission to the administration's goals and wants, and you just want to keep that out of public view. But at the same time, if you think about like even like 6 years ago, when the Fed started to embark on quantitative tightening before the pandemic, they immediately stopped after the market took a big hit. And so there's this like running joke that the Fed reacts to the equity market more than it does to its mandates in some respects. And so I think there's always going to be a criticism on what approach you take. And I think both sides kind of have valid points either way. I think if you believe Kevin Warsh is being honest about his intentions, I think what he's basically saying is, I don't want to like handicap policymaking or entrench it because we're trying to smooth it out and trying to communicate everything up front, when everyone agrees that it's also proper and essential that you change your mind if the conditions change. So I think he's just trying to be more nimble about it, but it does increase uncertainty and volatility to the extent that people can't like theorize, plan, come up with insights around what the Fed might do at any given time.
Yeah, that's the thing that I think I want to just kind of dig a little bit deeper on. And this is more so my opinion, is that we've had a market structure that's continuously moved towards faster, and you could argue whether the data is higher quality, but it's faster data. We have a lot of higher frequency news sources, and that's led to I think overall transparency push in global markets. And I think this would be a major thing to kind of take a step back on forward guidance and reduce transparency from the Fed. Ultimately, the risks that I see happening is, if you reduce forward guidance, if you reduce transparency, you elevate tail risks, particularly in rate expectations. Um, it's very, I think, reasonable to assume that could demand wider risk premiums and duration sensitive assets. What that means across markets, well, of course, any cross asset analyst would tell you that if you've got higher duration risk premiums, you're going to have to demand higher interest rates. That's something where I think, I worry a little bit that could backfire in some of the administration's clear goals, and assuming that interest rates do need to come down, the borrowing costs are getting out of control, and this could actually, in fact, hurt that kind of initiative if you start to see markets demanding higher risk premiums because of the uncertainty. Mark, Thomas or Dosi, do you guys have any other thoughts on this that you want to share?
But if
Yeah.
I could add really quickly one more thing on the forward guidance that is probably worth remarking, it is he was a bit contradictory in the sense that he simultaneously said we shouldn't be as communicative or provide as much guidance as we already do, but then in response to questions around or concerns around quickly reducing the balance sheet, which is a goal of his over time, he basically said that that would be a public discussion, acknowledging that it took a very long time to get here and that he would want to be like very transparent about how they intend to do that. And so it's almost like I want to be more nimble and agile, but when it comes to the balance sheet specifically and reducing that over time, which has that impact on the longer rates, like you're mentioning, I want to be more thoughtful.
Yeah, I think Mark, you wanted to jump in there.
Yeah. Yeah, I was just gonna say I'm kind of skeptical about how much balance sheet reduction we're actually going to get done. I mean, the talking point came up a whole bunch, but yeah, the reality is the equity market's not gonna love that, and like I don't know how much they're gonna be able to do because yeah, the last couple times we've tried to taper it in 2018 and 2013, it didn't go over so well. So
Yeah, well, we
yeah,
know
I'm
that
not sure how much
also
how much capacity they have.
we've seen how the balance sheets kind of already started to expand since they've cut QT off in December too. So that's something to kind of like be mindful of. Is that would be a rate of change in the direction that we're currently heading in. If you wanted to start reducing, and I think that yeah, we all know that forcing more supply in the markets, especially with higher deficits, is just probably not technically going to be very accommodative from an interest rate perspective, and particularly for the political dynamics where you have high mortgage rates and housing affordability. Selling mortgage-backed securities would certainly make the spread on mortgage MBS versus Treasury just widen even more. So definitely a lot of questions.
And you have an ongoing war too.
That's
with,
true.
with an ongoing war. I mean, they were already talking about dramatically increasing the military budget, which is just going to blow the deficit out even further. So,
the next topic of conversation I think we should jump on is strategies, continuous purchase. Tomas, I know you've got a lot of data that you comb through with that. And I don't know if you want to share kind of like the latest, either through regulatory filings or what we're seeing in the news. But it looks like the strategy buying spree continues, right?
Oh yeah, yeah. I mean, I think the notable shift they've accelerated their buying over the last couple months. But what's notable this month in April in particular is that they've done year-to-date highs in terms of weekly purchase activity for their filings. So last week they bought $2.5 billion of Bitcoin, which was both their largest in dollar terms, but also in terms of the number of Bitcoins year to date in a single week. And they're also on pace in April to hit a 16-month high in terms of their monthly purchasing activity. So going back all the way to like November 2024. So they're definitely pressing the gas. What I've noticed is that more recently they've really leaned into an explosion in the volume of their stretch preferred equity to issue a lot of that as the main funding source. They continue to issue some of their common, and I noticed that they actually have had a pretty substantial expansion in their price to NAV premium, which gives them more opportunity to lean into the common going forward. But yeah, this month has been notable in terms of the acceleration. They're at a 16-month high in terms of monthly pace, and stretch is certainly a big part of it.
Yeah, I think that the interesting dynamic that I'm going to kind of follow along just to see it. I think the main question is like it's all about sustainability in the end, right? We've seen how much the stretch perpetual product has been well received by the market, and that 11.5% annual dividend. I think it's paid monthly, but I think I saw him tweet something out that he might do a biweekly dividend. I'm not sure what that is, but it's seriously something that I think a lot of people are finding a lot of utility with, as far as getting Bitcoin exposure in a different way. And the thing that I'm kind of keeping an eye on is the MNAV premium. That's very similar to how kind of closed-end funds price. We always talk about closed-end funds as kind of like having these premiums or discounts. Well, MicroStrategy also has kind of like an MNAV and a lot of these DATs too as well. And the real question that I see, and I'll throw this over to Mark. How sustainable is everything if we see continuation MNAV compression and actually like a sub 1.0 MNAV, meaning that the actual market's pricing a discount on the net asset value of MicroStrategy?
Yeah, I mean, in theory, as long as your MNAV is greater than one, then I mean, it has to be a decent amount greater than one when you figure like the costs of issuing the equity and everything. But as long as that exists, you can always you should theoretically always be able to get more capital. And the unique thing about MicroStrategy versus all the other corporate issuers really is they have a wide, they've got a pretty diverse capital structure, a whole bunch of instruments, and they've also been able to raise a ton of capital. So there's also like there's got to be some type of additional premium just based on their ability to continue to raise money or their size. Their size is definitely worth something.
And when it's below one, that's because every equity dollar raise, or in this case, issuance through perpetuals, this is debt, I guess. You have this dilutive dynamic with BTC per share, right? So right now, I think the MNAV is still at a premium. I think it's at 1.2, but it's clearly gone down from 2.6 times MNAV, which we saw on the peak, I think, in late 2024. And we have actually seen it come below, I think, one, or drop below one in November, when we had a lot of kind of like bear market selling pressure in Bitcoin. So I think it's just really going to be dependent on obviously Bitcoin price, and certainly the ETFs have also been buying as well. I think IBIT's brought in over $1 billion in net fund flows in the past 5 days. We just recently did some analysis work there yesterday, Mark and I. So the Bitcoin market's still seeing, I think, a lot of people step in, and that's broadening out to, I think, more wealth advisors, asset allocators on the institutional side, and less more so on the retail or the fast money hedge fund basis trading side.
Yeah, and then another thing with MicroStrategy to consider is what percent of the Bitcoin supply are they ultimately going to end up holding or attempt to hold. I saw it online somewhere the other day that they were targeting eventually 7.5%, and they would look to do that in the next couple of years. So like this would start to like the issuance will eventually start to taper off. So you kind of want to factor that in when thinking about the multiple. If they're less likely to issue going forward, then there's less of a reason for that multiple to compress.
It's levered Bitcoin, and that's certainly appealing for some. Tomasi, I should say. I know you've been wanting to jump in here. I think this next topic is definitely something that you want to jump in on, and it's in regards to the CME launching their 24/7 trading on Bitcoin, ETH, Sol, and XRP futures and options. And that's, I think, going to be effective. Was it July, or I'm sorry, in May 29th, or do we have a date yet?
May 29th.
May 29th. Okay. And so, yeah, I think this is a pretty big watershed moment as far as regulatory derivative standpoint. It's been always the case that if you want to get weekend exposure, you have to go offshore to other venues for futures, and this certainly kind of closes the gap, right?
Yeah, definitely. It will be really exciting to also have that price discovery on weekends as well. By the way, that doesn't just cover Bitcoin, Ethereum, Solana, and XRP. Now we have 3 additional futures that are covered on CME. So we have Cardano as well, we have Stellar, and we have Link, and 2 new assets will be added on the 4th of May. So we also will have AVAX futures, and we'll have SUI futures as well. And to have that entire complex just trading on weekends is just a massive unlock. We've seen in recent history all the liquidity on DeFi native venues that happens, where price formation in certain markets that just really happens in DeFi native venues, and to get some of that liquidity back on CME, also in the crypto space, will be hugely additive. And it's obviously for a juggernaut like CME to make such a foundational change. For now, it's just crypto, but they have hinted at potentially rolling out to other asset classes. It's just a pretty seismic shift.
And from a benchmarking standpoint, what are some of the key infrastructure, features that will be required for this move to start pricing things 24/7?
I think when it comes to our core product offering, weekend trading per se, that's just business as usual for us, right? So we print 7 days a week anyway. When it comes to our, let's say, our flagship products like the Bitcoin reference rate, we always have done. Our Bitcoin reference rate, for example, has never had any outages since it's in all of its existence. Now, when it comes to more of the second generation type of products, so futures based products, so let's say our CME rolling futures index, or when we talk about our CME Bitcoin volatility index, which obviously relies heavily on futures and options prices traded on CME, that's a different story, and that's where we will have to. We'll have plans to observe liquidity, how that will evolve in the beginning, over the weekend, before we'll be comfortable including these prices actually into our indices, and to also print these indices on the weekends. We're fairly, let's say, confident about how that will evolve in the beginning. We know what kind of market maker support that will be available, and we think the liquidity, how it will evolve over weekends, will be similar to how it evolves just in crypto native markets, where you see maybe a bit of a dip in trading volumes over weekends on normal, let's say during normal conditions, and that will probably mirror to liquidity, how it will unfold on CME on weekends as well.
Yeah, for the audience, it's maybe just great to just take a step back and describe why 24/7 is so significant. The way the traditional markets price on the CME is they have these closed, either like a daily closed hour, or they have this, longer time period close over the weekend. And what that looks like is on Friday at 5 p.m. the futures stop trading, and they don't open for trading until Sunday at 6 p.m. Over the weekend. So you have this huge, what we call like the weekend gap, basically, which in some cases, some people view that as kind of like a tax for portfolio managers who are using the futures to either hedge or take positions, because you cannot manage your position over those hours. On weekdays, it's much smaller. It's only an hour. It's from 5 to 6 p.m. The futures stop trading. But the move to go to 24/7 is obviously going to close these gaps, and it's going to allow, I think, a lot of the practitioners to either hedge exposure or take positions. And that's significant in a few ways because of what we've seen over the past few months, right, out of the Middle East. Most of the headlines, most of the uncertainty has occurred over the weekend hours. It's actually kind of a running joke, I think, on crypto Twitter. I think I saw that the Strait of Hormuz has been closed only during non-market hours. And then, so I guess my question is to the rest of the panel is, do you think this, if we're still in this kind of uncertain environment in the Middle East, do you think moving to 24/7 is going to change this dynamic where we see the Strait of Hormuz just being closed during non-market hours, or is this going to kind of force maybe more negotiations from a geopolitical sense?
Yeah, I think we'll see less targeted. They're definitely moving with the headlines and a lot of the actions they're taking. You could tell that it looks to me that they're definitely targeting the weekends when markets are closed to limit volatility. So my guess is they either stop doing that altogether, and you'll see events happen during the week, or you'll
it will
see
be
them
hard.
try to do it during low liquidity on the weekends.
It will be hard to limit that if it's a 24/7 market,
Yeah.
right? So no, that's just something that's interesting. Of course, I think there's a lot of questions about liquidity, and certainly during off hours over the weekend, there's lower liquidity. But so long as we, I think, have geopolitical uncertainty, I suspect that actually right now is not a bad time to move forward with the change to 24/7, because you would definitely see, I think, demand for trading given what's happening, it seems like, every day and each weekend. But speaking of 24/7, I think the last top story that we want to dive into is the Kraken binomial acquisition that was announced last week on April 17th. The deal included a cash stock offer. They announced that they expect to close in the first half of 2026. Binomial, of course, is the first crypto native exchange holding all three CFTC licenses. For those that are unfamiliar, the three CFTC licenses in detail are the DCM, which stands for Designated Contract Market, the FCM, Futures Commission Merchant, and a DCO, it's a derivatives clearing organization. And having that license stack basically allows Payward, the parent company of Kraken, to accelerate, I think, the timeline that it would be required for them to get these types of licenses. These things take a long time if you want to just do it yourself. So from like a strategic standpoint, doing the acquisition and getting the licenses through Binomial is something that kind of clears the way. I think one thing that I just wanted to kind of bring up as kind of like a high level talking point was Arjun set these comments on how this is going to unlock spot margin, perpetual futures in a CFTC regulated fashion in the U.S. for the first time. I think there are some perpetual futures through Coinbase, but for Kraken, this is obviously a big deal. What's everybody's take here on this move? It seems like everything's going to 24/7 markets, and perpetuals are just becoming more and more popular. I don't know if Tomas, you want to start and just give us your take on that.
Yeah, I find it interesting because it's such a different product, because you have like variable funding rates, and so it's not the same as like what people typically think of with like futures market where you can lock in a carry. In this case, when you put on these positions, like your cost, it actually looks a lot more like shorting stocks in the sense that it's a variable rate loan or funding rate that can change like very quickly depending on supply demand conditions. And so I'm very intrigued to see how the market, let's say, like absorbs it. I think it's like a more straightforward, like retail friendly product in the sense that you don't have to deal with things like massive contract sizes. And so you have to bifurcate the market between regular contracts and micro contracts. Like the Perps market has always been built for a retail investor audience. And so I think it'll be really interesting to see how behavior shifts as these products become more accessible. But yeah, I think to Arjun's point, the coolest part about having what I'll call like the holy trinity of these three licenses in one house is that historically the financial services across the board are so fragmented that the pace of innovation is as fast as the slowest person in the chain. And so when you get to play a part in all components of the flow, whether it's the DCM, the DCO, the FCM, you're able to really rapidly innovate, bring stuff to market, and test. And so I think that's what gets me most excited. I think time will tell whether it meaningfully shifts consumer behavior, but it's the first time in probably a very long time that you've had the opportunity to test that, and I think that's really exciting. Perhaps the last time was, maybe like when electronic trading first became like a real thing. So it's as exciting as it gets.
One angle that I'm going to keep an eye on is how this impacts ETP go-to-market timelines for spot. Last September, of course, the SEC issued their generic listing standards for commodity-based trust shares. This basically allows a path forward for tokens to get wrapped in a traditional kind of open-ended ETF wrapper, which is kind of like the holy, or like let's just say it's like the gold standard of financial products right now for regulated financial products, and that's where I think a lot of tokens are trying to go towards. Well, if you have a CFTC regulated futures contract with the token for over 6 months of trading history, that basically clears the path for GLS standards, and that I think helps more venues help tokens go to market, and that kind of accelerates, I think, adoption in a more broader sense with more tokens getting that ETF treatment. So that's something that I'm personally kind of keeping an eye out for. Mark, is there anything that you took away from this news?
Yeah, I'm a pretty big fan of the perpetual futures in general, and I'm actually very bullish on like the share I think that they're going to take from fixed term contracts. Just well, one from on a retail standpoint. So if we think about it, retail now makes up, and analysts estimate anywhere from 20 to 25% of equity volume, which is a pretty significant chunk. And that's specifically on single name equities. Another place that retail is even bigger, though, is in the derivatives market. So options, especially short dated options, retail actually dominates that and takes almost half of the market. So they're almost half of the trading volume there. So when you give them these perps, easy access to leverage on a regulated venue like that, it's natural you'll see growth from retail. But I also suspect that you'll probably see a good amount of growth from institutions starting to trade perps. Now, there's certain things where the fixed term futures are probably gonna stick around. Like if you're trying to farm the basis or something, you're gonna want to stick with the fixed term contracts to lock that in. Or if you're trying to specifically hedge something, fixed term makes more sense there. But if you're just like a macro fund and you're using futures for leverage to be more efficient with your cash, there's very little reason not to consider using a vehicle like Perps, especially if you have all that volume and all that underlying liquidity from retail on it.
Yeah, that's a really good point. And when you say fixed term, that's basically like more the traditional futures,
Yeah.
the maturity structure. And that's really, what we've seen so far in financial products. And really the crypto space is what really popularized this thing called a perpetual futures, which has these mechanical repricing of borrow or margin that you have to pay with the funding, right? Based on kind of supply and demand on whether people are trying to long or short the said futures contract. Thomas E, I wanted to get your take here on perpification, on everything that's going on chain. It just seems like things are just picking up more and more. I guess what are you seeing from the seat that you sit in on the chief product side?
Yeah, it's certainly interesting. You kind of have that sort of two-way traffic when it comes to innovation. On the one hand, you do see crypto-native vehicles such as Perps travel in the direction of TradFi, which we see in this current case with Nomial, right? Which is just pretty exciting. Important to remember that it was BitMEX originally that came up with the whole Perp structure. And then on the other hand, we see a lot of sort of interest and direction the other way from TradFi towards on-chain. Obviously, a lot of TradFi institutional interest, especially in tokenization, and we see that demand on our side as well at CFP. So we're actually working on specific CFP Oracle services at the moment. So that's like actual oracles that will carry CFP's official benchmarks and values on-chain, which will basically bring DeFi users the same sort of high integrity, representative, and replicable benchmark prices as enjoyed by users of TradFi institutions and products, the likes of BlackRock and so forth. And I think that's sort of the direction of travel that we're seeing there, and it's a pretty major initiative for us, and it follows what we've already done. So we've tokenized one of our indices, LCAP, so that's our CF large cap token. So that's an actual token that you can now buy on various DeFi venues. So on chain is big focus for us, and clearly for TradFi institutions as well.
That's basically you're getting a full portfolio of multi tokens in basically in one instrument, right? So it's kind of a cleaner way to get more exposure to other theses, other things in the market versus just having to maybe have like a basket of perps, right?
Yeah, exactly. So think of it as the S&P 500 of crypto, FTSE 100 of crypto. It's a basket of cryptos representing just beta, so that's just the market, the crypto market. And what's just cool about it is the distribution angle. So you can just, it's wrapped as a token, and it lives fully on chain.
That's pretty cool. This kind of, I think, is a good transition over to the next segment of the show where we want to talk a little bit about some deep dives that are happening in the markets. The first deep dive, we want to talk about AI and DeFi security. On April 19th, we learned, unfortunately, that the Kelp DAO was drained of, I think, close to $300 million via a Layer 0 bridge exploit. Ultimately, I think Aave had to freeze the RS ETH markets, which is a liquid staking ETH market, after we've seen an exodus really and people lending to it, and it really kind of caused a mess really in the DeFi space. And I think the common theme here is that I think we're seeing more and more kind of these exploits happen. There's I guess there's more events surrounding this thing, and some people might tie this to maybe AI. Of course, there's been a lot of buzz around Anthropic's latest Claude model, which is Mythos. It's actually been kind of restricted from its release, and it's only been shared to a select group of either government agencies or companies in a project called Glasswing, which is kind of like a defensive research initiative to allow these players to patch up 0-day vulnerabilities across either operating systems or internally with their infrastructure digitally. So it kind of, I think, the timing of everything kind of uh, goes in a very coincidental fashion, in a sense that there's all this concern about more hacks happening in everyday life with these super powerful LLM models, and we just had this messy event happen in the DeFi space. I just want to kind of go around the table, and maybe Mark, I'll start with you this time, and get your take on what AI is. What is a DeFi world going to look like with really powerful AI?
Yeah, so I've kind of been looking into some of these LLMs and the exploits they can find, and they're really good at kind of going through the code base. And if you want to test a bunch of things rapidly, you can iterate pretty rapidly with them. But from what I've been reading and researching, is it does still require a fairly skilled actor as the user of the actual AI model to get through. We aren't at the point where these agentic systems can really go through and start to find their own exploits and put all the pieces together on their own to create something. So there is still the constraint, the human constraint, where you need a skilled enough actor to be able to properly prompt the thing to get something out of it. The other issue that we're seeing separately in the DeFi space is if we look at a lot of these exploits that are coming out over time, the failure tends to come when you have some centralized service mixed in there. So in the case of the RSETH or the Kelp DAO hack, it was the layer 0 bridge that got exploited, which was just a single server, essentially. It's a single centralized point that was attacked. And this has always been an issue with some of Ethereum's roll-up centric scaling model when they were going there. If you look at all the layer 2s out there, they're at stage 1 of decentralization, so they don't have a fully decentralized sequencer yet. So there's a few actors that can essentially control the way they work. So you saw how Arbitrum went and they froze some assets as a result of all of this. So we're starting to see, what parts of the ecosystem are still fairly centralized, and that's ultimately a risk here that has to be considered, because once you're centralized like that, can you be held accountable for any funds that are misused, or if the funds are used for the wrong way, or can you be held accountable for sanctions violations or anything like that? These are all things that you have to start to consider, right?
Yeah. Let me pass it over to either Tomasi or Tomas P. If you guys want to jump in and give your guys' takes on AI and DeFi.
I guess I could jump in real quick. On the DeFi side, I mean, I think the tricky part is that DeFi has been kind of abstracted into, or lulled people into like this oversimplified view of what it is, because a lot of people, the way that they interface or they get it advertised to them is, instead of getting like 3% in a bank account, here's a vault where I just put in stable coins and I get 6%. But then behind the scenes, you find out after the fact that there was like some kind of looping functionality, or funds went to a third party, or that the vault had a bunch of like different forms of collateral, whether it's like liquid staking tokens, that introduced this kind of like counterparty or bad funding risk. And so for a long time, I thought that there's been this like imbalance between how simple the experience looks and how attractive the rates are that are being offered, versus the complexity behind the scenes to like tail risk and the susceptibility to tail risk. And so I think this is kind of like a natural thing that happens. Like DeFi has grown a lot, and when you think about like a DeFi platform or a savings and lending platform, like how do you compete? It's usually by offering more aggressive LTVs and more collateral acceptance. And the detriment is that you're going to run into these things. AI just like accelerates the outcome to the extent you built it with exploitable platforms that an AI can sniff more quickly or help someone discover faults more quickly. But in some of these cases, we've seen that they involve like social engineering, compromising of actual people and their keys. I think the outcome that we're probably going to see over time is hopefully like true increase in decentralization. That is, no more admin powers and things like that. That straightforwardly make it so that the platform operates as designed, hopefully in a way that isn't going to get exploited, and in a way that I think is going to honor like more basic tenets, so that when people take a 3% credit spread, they're not taking like massively more risk than they think they are.
Yeah, it is in the end of the day all about counterparty risk, and that's certainly not that's not anything specific to this industry whatsoever. That existed in TradFi for many years, and case in point, 2023 with Silicon Valley Bank. All these regional banks were kind of viewed as the same kind of credit risk and counterparty risk, but some banks weren't managing their interest rate exposure responsibly, and ultimately were caught without wearing any shorts once the tide went away, as they say. And then you saw that subsequent run on the bank and the failure. So in some ways, DeFi is kind of going through, I think, some of these same kind of learning points where you can't treat every protocol or every lending pool as the same counterparty risk. You have to throw in these central points of failures that Mark was alluding to when he was giving his points. You have to kind of sniff this stuff out, and to kind of take the other side of the AI risk uh, threat. I think it's pretty obvious to just say, for the developers, for the builders that are going to use these LLMs to patch their securities, they'll probably be just fine. As these things roll out, it's the ones that I think are not ahead of the game, aren't aware of this. I mean, I remember it wasn't too long ago when I think shortly after Opus came out, that we saw a lot of SaaS cybersecurity companies sell off because the thesis was that everybody was going to start patching up, their cybersecurity using the LLM, and the need for these, cybersecurity management companies is kind of less impactful in a world where AI is basically reviewing your code and patching things up instantaneously in a much faster way than a group of engineers could. And so this is kind of, I think, the other side of the coin of what's happening with AI and its risks about exploiting things. So, um, Thomas E, I'm not sure if you want to give your 2 cents on what's going on here.
I think plenty's been said on the security aspect. I think there's an important place for AI. Just to end it on a slightly positive note, there's an important place for AI in DeFi. What I think is important is that there is an operational risk angle to it as well, and I think that's where data quality becomes existential. So I think powerful AI amplifies whatever it's fed, and just bringing it back to just what CFP does and bring that sort of data on chain. Split second decisions on bad price data doesn't just lose money, it can destabilize protocols. And that's why that piece, that for infrastructure safety, it's important, and it's directly relevant to what we build at CFP.
That is a really, really, really good point. Having that price safeguard as an infrastructure benefit certainly could help kind of mitigate some of these risks. But looking at the time, we are kind of approaching the hour that we allotted here. So I just want to pass it over to Mark, who can give us a little bit of a deep dive on our CF benchmark factor performance for the first quarter. We just released our Q1 report earlier this month. Mark, what's going on with our factor model?
Yeah, so our factor model over the last quarter did produce some interesting results. So I'm going to talk about this in the context of long-short portfolios. So what we're doing for each factor, just for everyone's listening, is we're taking a score for, say, size. So we'll take the smallest market cap and go long all the tokens with the smallest market cap, and then we'll go short the largest in the top 50th percentile. So that's what we're doing. We're taking all of these different factors, scoring our investable universe, and then we're going long and short the top and the bottom half of them. So during the drawdown, we actually saw some pretty good results from our downside beta factor, with that outperforming all of our others. So that's going long the assets with the lowest downside beta, the lowest downside sensitivity, and then shorting the assets with the highest downside sensitivity. So it performed about as expected. And the assets with the lower downside sensitivity are some of your large cap tokens like Bitcoin are in there. Ether, I believe, is in there on the long side. So we saw those assets hold up relatively well and actually outperform. The other thing that we saw this quarter is we saw our size factor. So our smaller cap assets do better relatively going into the beginning of the year. So we saw some momentum out of that. What didn't do well, interestingly, we saw both our growth and our value factor. So the tokens that are growing fees and users the fastest, and then tokens that are with the most efficient on-chain metrics. So think fees generated relative to TVL on-chain. Actually, none of those really performed all that well, and it was relatively on the long side. So the long side or the short side underperformed the long side there. So the tokens with the better scores did worse. So we had a pretty interesting kind of quarter where the only thing that really did well were the more defensive tokens and the more small cap tokens. So pretty indicative of just a broad. We just had a broad, sell off that was pretty indiscriminate. There was no real pattern underneath of the market as to what was kind of driving it. It was just everything at once.
It's where I think this type of framework really starts to add a lot of value for practitioners, because it's in those moments when you get kind of these broad indiscriminatory sell-offs that you can find really attractive entries on tokens like you were mentioning with the growth names. These are tokens that are, have a lot of fundamental catalysts backing their blockchain activity, the fees, and a lot of efficiency that is pretty desirable in any type of kind of investment asset allocators framework. And I think having this kind of filter, this kind of view, allows practitioners to kind of screen this stuff out in these markets and hopefully find good opportunities for entry, really. So I think...
Yeah, and it also showcases a pretty interesting inefficiency in the market. So typically in the equity markets, if we look at these factors, when we get a drawdown, we'll actually see like the value factor outperform the growth factor as you see that flight to quality from investors, which you really didn't see here in crypto. So if you're looking for kind of an opportunity, or if you're looking to see what the market's pricing, it's almost as if the market isn't really looking at those metrics yet. So, if you're an investor and you're paying attention, that's where you can gain a bit of an edge on other market participants.
That's a good point. Gentlemen, is there anything else we should add with CF factors before we close things out with our final week ahead roundtable? I take the crickets as a sign to close things out. So with that, I think I just want to get everyone's opinion on kind of what's top of mind. It doesn't have to be next week. It can be tomorrow. What are some events? What are some things that you're keeping an eye out? Whether it's economic events, something happening in the news, something happening with market activity. And I'll go ahead and just go with Thomas E, since you're right next to me on the CF Benchmark space queue here. If you want to just share what you're looking at.
Just across the board, on-chain activity. Watch the CME announcement schedule. I think that's always a good idea. And watch the CFE announcement schedule. We're coming up with some absolute bangers on the product side.
There you go. There you had it right there. There's the news clip. We were giving you a preview on some drops that could be coming soon. So keep an eye on that. Tomas P, what do you got for us?
As far as like interesting things to watch out for?
Yep.
I think near term it's still everything to do with this Fed, and at this point it's like a very news driven story, so it's not something that Kraken is going to be proactively providing content. So keeping an eye out on the news for any changes in at the Federal Reserve with this leadership transitioning happening supposedly in mid-May. And another big one I think is going to be any progress on the Clarity Act is like another news-driven catalyst that I think is going to start making headlines in the next couple of weeks that people are going to migrate their attention towards again because we're kind of approaching the summer campaign kickoffs, and so people really want to see progress on legislation here in the near term. So those are the things that I think keep me up. I'm otherwise like actually pretty positive on just like the trends in Bitcoin ETF flows and this price level. They've been very positive, and so I think we've hit a little bit of an inflection, and I'm wondering if the trend's going to stick or not.
Yeah, those are all good points. Mark, what's on your radar?
Yeah, just over the next couple of weeks, we have earnings coming up, and specifically the corporate treasuries are going to start posting earnings. So we'll have BitMine's earnings here in a few days, or probably I think it's a Thursday of next week, and then we have MicroStrategy's earnings coming up in May. So it'll be interesting to dial into those calls and hear how those teams see the market and what their plans are for capital raising and deploying future capital.
And one or a couple things from my radar. Obviously, tomorrow I think we get the March PCE print. That's of course the Fed's preferred gauge. This is, I think, the last clean read before the May 6th to May 7th FOMC meeting. Of course, Tomas, you brought up a good point. I think we got to keep an eye out on what's going on with Kevin Warsh and his succession plans. It's going to be interesting to see if the administration does pull its DOJ investigation into PAL. It seems like that's kind of like the key thing to get the next Fed chair confirmed. Otherwise, the math really doesn't work out for him to advance. We've also got Q1 GDP coming out on Friday, so that's something to keep an eye out. I think there's going to be it's going to be interesting to see how personal consumption and how investments held up with all the uncertainty that we've had out of the Middle East and the war. And like what Tomas P was saying, I think you got to keep an eye out on these fund flows. These fund flows have been pretty strong, mostly going into BlackRock's IBIT for Bitcoin. They've bounced back along with the price, and I'll just keep an eye out on that, and hopefully, the appetite stays strong. So these are the things that I'm looking out for, and I think this wraps us up just around time. So I want to thank everyone for joining in and listening to us for our second CFB X Space. And feel free to drop comments or feedback, and look forward to doing this again. Trade safe. Thank you.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.